Three of the biggest banks already out with their earnings, Wells Fargo among them. Those shares down about 6%. Some concerns here about higher than expected costs. Some concerns right now here about a slowdown in cost-cutting efforts. Mike Santomassimo joining us right now, the CFO over at Wells Fargo. And Mike, let's start off with the cost-cutting here. Some commentary in the press release, some commentary on that conference call about a slowdown in some of those efforts. Characterize us as to what exactly that means.
Well, thanks again for having me, Romaine and Alix. I appreciate it. Look, I think you got to look through into the quarter, and it was actually quite a solid quarter. We saw really good momentum in our fees, revenue-generating businesses that more than offset sort of what we saw as the expected decline in net interest income. We saw, headcount continue to come down, and the core efficiency agenda still in place. We saw good capital return to shareholders. We saw our investments really start to pay off, in terms of that fee income I mentioned. And so there's a lot of opportunity there. On the expense side, it was really three things that sort of drove the increase in the full year guidance. First is revenue-related expenses in our wealth management business, which is a good thing because there's revenue that more than offsets all of that. And so as the equity markets stay higher than what we predicted earlier in the year, that is a positive contribution to earnings, but it increases the expense line. Second is related to some remediation costs that we have to put some of these client remediations that are related to some historical matters behind us, and that was in the first half of the year. And the third is the special assessment for the FDIC related to the events of last year. So when you look beyond those three things, the core efficiency agenda is still very much the same as it was last quarter, last year, and we continue to execute on it and feel really good about the opportunity we have there.
With regards to the FDIC costs and the other customer remediation costs, in theory, costs that should be temporary, are we sort of at the end of this path? Is there a light at the end of the tunnel when it comes to those issues?
Yeah, well, I think the remediation stuff was related to a couple matters, they're historical, and so we're nearing, we're closer to the end on those than we are otherwise. And on the FDIC, that'll be driven by the losses that we see ultimately through the FDIC fund there, but we've accrued for everything we know about there, and we'll see how that progresses. And so it shouldn't, we don't know that it'll be any higher than it's been, and so we'll get more information each quarter from the FDIC.
Hey, Mike, the other part of the quarter that disappointed the street, though, was net interest margin, net interest income. And a big part of that is going to be that loan demand. Why do you guys still see that loan demand as tepid when a lot of your peers don't see that? What is it specific to Wells Fargo?
Well, I think, keep in mind that the guidance we put out there for the year is the same guidance we put out in January, down 7 to 9%. We just said at this point in the year, we think we'll be around 8 to 9% versus, anywhere else in the range. And so the guidance is still about the same. So most of what was in there actually, was very similar to what we expected to happen. Loan growth has definitely been a little bit weaker than we thought as we looked, at the beginning of the year. And I think that's generally the case in a lot of other places as well. And I think we've been very, very consistent about our underwriting standards and the way we're approaching it. So we're not out there chasing growth by taking more risk. We're actually very much just being very consistent over a long period of time. But underneath the NII trends, you're actually seeing some positive trends. Deposits are up, in all of our lines of business versus the first quarter. That's the first time in a couple of years that's happened. And so there's actually some positive trends that are happening underneath there as well.
I mean, I hear you, but the stock is still down 6%, and it's even off its lows versus your peers. Like, there's clearly something that is worrying investors, and those cost measures as well as net interest income were those two worries. What do you think happens to loan growth and net interest income as the Fed may cut rates?
Yeah, well, as the Fed starts to cut rates, our deposits will begin to reprice downward as well, particularly on the wholesale side. So that'll be a positive as you start to see, that happen. And I think rates are one part of the equation for what we hear from our clients, right? So you have the election coming up, you have rates still being high, you have some uncertainty still out there in the economy to make sure this soft landing is really going to materialize in the way people think. And so I think as we get through the year, you'll start to see, clients do more from a lending perspective, as well as consumers. If the stronger the consumer stays, I think you'll start to see some more growth there as well.
Mike, I have to ask you about some of the efforts that Charlie Scharf has made to kind of broaden out this business. Obviously, Wells much more known for the consumer side of that business, the mortgage side of that business, but you've made some decent strides so far in the trading space and, of course, in some of the more traditional Wall Street types of businesses here. How do you accelerate that, though, in a way that is going to satisfy investors?
Well, I think it's not about acceleration. It's about being very consistent in our execution there. And I think, we've been talking now for a number of years about a few areas of investment. First is the credit card business, and I think you see that come through, the new accounts and the growth and balances there. Second is the wealth business, where we've, again, seen growth in the advisory fees. We've seen, our attrition in advisors slow. And I think, we think there's opportunity to continue to grow there. And then it's in the corporate investment bank and the commercial bank, and I think we've been hiring and investing in people and capabilities there for the last few years, and I think you're starting to see that really come through, both in the trading line and the investment banking fee line, and I think that's something that will kind of build, methodically over time. There is no trying to accelerate by taking risk. We have to be very consistent about how we go about it, and I think we're starting to see the benefits of that come through.
Mike, we really appreciate it. I know it's a busy day. Thank you for taking the time. Wells Fargo CFO Mike Santomassimo.